The jobs report giveth, and the jobs report taketh away. Big news from the jobs report last week. And as always, I want to welcome everybody to SRT Live. I am your host, Sean, with the Sean Richard Mortgage team here at Guaranteed Rate. Thank you so much for joining me on this fine Tuesday afternoon. Well, I'm excited. We've got a big week. I feel like I say that every week, though. Last week, jobs report. This week, we're going to dive into inflation. So jobs report inflation, jobs report inflation, jobs report inflation. We're just getting teeter-tottered in between two major components of the economy right now. And they're both having substantial impacts on our economy and on our real estate and mortgage markets. So let's start, as we always do, with our week in review. Last week, big week, on Wednesday, we received the ADP payroll report. Now, this is a precursor to the jobs report from the Board of Labor and Statistics. And the ADP payroll report is been revamped recently. And there are some people out there that feel that the ADP report is a more accurate report than the BLS jobs report. So as far as new job creations for the month of March, ADP says that we had 145,000. This was versus an expectation of the report of 200,000 and down from 261,000 the prior month. So according to ADP, last Wednesday, pretty big miss on job creations. Now, fast forward to Friday, and we got the BLS jobs report showing that we got 236,000 new jobs created versus 240,000 expected. So really right in line with expectations, but still down from the previous report of 326,000. So according to ADP, the job market's softening. According to the BLS statistics, we've got a resilient, strong labor market. So what gives? Which one is accurate? And that's where looking further into the jobs report gives us a little bit of insight. One thing to note when looking at the labor market is we typically are going to see a progression. It's not going to be companies are hiring like crazy and all of a sudden they're firing like crazy. We're going to see a steady progression through the phases of the labor market. So phase one is companies are hiring. Okay. Phase two, things start to downturn. What's some of the first things that they do? Well, they put a freeze on hiring. They slow down or stop hiring altogether. Now, let's say that there continues to be a downturn. What's the next step for a business to help cut costs? Well, they're not necessarily going to immediately start laying people off. They're likely going to take the hourly workers and they're going to cut hourly. They're going to cut the number of hours that they work. If I've got a 40-hour employee and I can cut them down to 36 hours, and I do that with 75% of my hourly employees, I've saved my company a significant amount of money. So that brings me to the next data point is average weekly hours dipped by a tenth of a point to 34.4 average hours per week nationwide. Now it dipped from 34.5, and you may say, okay, well, a tenth of a point doesn't seem like a big difference, but when you extrapolate that out across the entire labor force, that is the equivalent of laying off 460 or a job loss or laying off 468,000 workers. So it does have a significant impact in the grand scheme of things. Now, another point to note is that the 34.4 average weekly hours has the lowest level that we've seen since 2019 in September. Now, COVID period excluding, that obviously was very different. But outside of COVID, we haven't seen the average weekly hours that low since September of 2019. So the next phase after freezing hiring is reducing those hours worked. And then the final phase would be actually letting employees go. So we talk about the jobless claims, unemployment claims on a weekly basis. Last week, we had initial and continuing claims, as we always do. Initial is individuals filing for unemployment for the first time. Continuing, individuals renewing their unemployment benefits. Well, the initial claims came in at 228,000. This was a stark increase from 200,000 expected. It is down from the previous report of 246,000, but we are now steadily north of 200,000 when we were hovering quite a bit below 200,000 for a number of weeks. Continuing claims, we saw a significant jump from the expectation of 1.69 million up to 1.82 million. Now, this was in line with the previous reading of 1.81 million, but we're seeing a tick up in jobless claims. But remember, this is the last piece of the puzzle, the last shoe to drop. Once we see a further downturn, companies will start to lay off workers, and that's going to show up in those initial claims numbers. In the meantime, we've got other indicators showing that the labor force may be slowing down. Now, the unemployment rate did tick down from 3.6 to 3.5. Remember, the unemployment rate is via the household survey, surveying the survey of households, and then the BLS jobs report is the business survey. So they're surveying companies. Unemployment is surveying households. So there's going to be a discrepancy between those, and a lot of times there's a pretty big gap as well. The household survey showed that there was 570 some odd thousand job creations for March, whereas the BLS survey only showed 236,000. So pretty stark contrast between those two reports. We also completely went blank there. So we also have a big week ahead of us. So far this week, yesterday, today, not a whole lot of news, nothing really that's moving the markets. We're kind of in the statistical zone, meaning we're looking at charts for mortgage-backed securities, and the statistics and the data is driving that versus economic news. Now, that all changes tomorrow. Tomorrow we get CPI, which is a key inflation metric. So we've got headline and core. Remember, core inflation as after stripping out food and energy. The Fed feels like those are more volatile. Their monetary policy has less control. So core inflation is really what they tend to focus on. But we get CPI tomorrow. We also get the meeting minutes from the last Fed meeting. Not a whole lot of new information expected from that, but it does give us a little bit deeper peek into the minds of the Fed members and what they might be looking towards going forward. On Thursday, as we always do, we get jobless claims. We also get wholesale inflation via PPI, Producer Price Index. So back-to-back inflation figures this week should give us a lot of insight into what we expect the Fed to do at their next meeting. And then on Friday, relatively low-key day, but we do get the University of Michigan consumer sentiment. All of you great people out there we get to find out how everyone's feeling about the economy and where everyone feels like we're headed economically going forward over the next 6 months or so. So that's coming up on Friday. So what are we focused on for the next week? What are we keying in on? Well, we're keying in on, can we get over the hump? And what I mean by that is twofold. Number one is inflation. Inflation has to come down at some point. When inflation declines, we're going to see mortgage rates decline, and we're going to see additional demand come back into the market. So if you're a real estate agent, make sure that you are having that conversation with your clients. You've heard it abused almost, the date the rate, marry the house. I'm not a huge fan of that line, but it is true when we've got an elevated interest rate. When given the choice between high prices like we had last year and coupled with low rates versus high rates and stable prices, I'm going to recommend taking the high rates and the stable prices, because if you end up with high prices, you don't get to go back and renegotiate the price with the seller a year later, 2 years later. Whereas the interest rate, you get to reset that via a refinance when and if the rate environment does decline. So really important. So looking at inflation, bringing rates down, that's going to happen when we start to see housing cost component of inflation catch up. There's always a lag in that. We saw Housing costs rise pretty dramatically over the last year, and that's now simmered down to less than 3%. I believe we're in the mid to low 2% range, but that hasn't filtered into the reports yet. Once that does, we're going to start to see the inflation figures come down. Housing cost makes up 43% of core inflation. Pretty big deal. So we're going to keep an eye out for that. And so we're going to be watching the CPI inflation data over the next 30 to 60 days to see how that comes to fruition. The other component that we want to get over the hump is the labor market, jobs. We've got several indicators that appear to tell us that the labor market is softening. Remember, one of the Fed's sticking points is that the labor market remains too tight, and the jobs report has told us that month after month for the past several months. So how do we get past this? Well, we've got the JOLTS report that comes out on a monthly basis. The most recent report, now JOLTS report is job openings across the country. We saw a stark decline on the most recent report for the first time recently, first time in a while, dipping below 10 million job openings across the country. So this softening could mean that the labor market's getting a little bit softer. It's easing. We also talked about the average weekly hours in the jobs report from last Friday. We're seeing that come down a little bit. And so we appear to be moving through that progression that I walked us through. We're seeing openings come down. We're seeing average hours come down. The next phase is going to be job cuts, and that will put us in a softer labor market, and that's going to ease tensions in the labor market. It's going to ease wage pressured inflation, which is a big component of inflation as well, and it's going to satisfy what the Fed is looking for out of the labor market. So my prediction going forward is I do expect lower inflation here over the next 3 to 6 months, and lower rates by really mid to late summer. So July, August, I think we're going to see inflation come down. A lot of the metrics that are lagging are going to filter into that CPI and those inflation reports, and we're going to start to see inflation dip, and that's going to bring mortgage rates down. So everyone that's buying right now is going to be in a great position to refinance over the next 6 to 12 months. Everyone who bought mid to late last year is going to be in the same position. So a lot of opportunity to save money in the near future. However, if you're a home buyer watching this and you are looking at purchasing in the not too distant future, remember, as those rates decline, everyone that has the same mindset as you that says, hey, I'm going to wait until rates come down is going to re-enter the market. And we're going to see demand pick up, possibly substantially, but we're seeing supply stay the same. 30%, roughly 30% of home buyers are first-time home buyers. They're not contributing to inventory on a monthly basis. Another 19% are investors who are also not likely contributing to inventory. So we've got nearly 50% of home buyers on a monthly basis that are not contributing to inventory. This is a big deal, and inventory is going to be a challenge for the foreseeable future. So as that demand rises, when supply stays the same, we're going to see prices start to rise again. So just remember, we're in this window of time where it makes sense to be able to get a home at a reasonable price before prices start to rise too much again. Rates have dipped from their peak last July, August. Even though they are still elevated, they're in a much better place than they were 9 months ago. So a great little window that we found ourselves in. One other note that I want to show you real quick. This is pretty cool statistics. Yeah, all right. So this is, I'm going to pull this up on my other screen over here. This is change in home prices. Let's see, can I make myself invisible? Almost. Now let's do this. This is change in home prices as a percentage year over year from 1942 to 2022. Now, I know a lot of you, if you're a real estate agent, you've heard, I know this is part of our plight of combating this narrative, but you know, real estate agents, you've heard that, oh, well, the market's going to crash. Home buyers, homeowners, you've heard people tell you, you've heard the media, oh, home prices are going to plummet. there are areas of the country where home prices have declined by reasonable percentages. Here in the Dallas-Fort Worth Metroplex, we have seen fractional declines in home prices. And this chart is a pretty good telltale sign of what tends to happen when we have declines. How much red do we see on this chart? We saw a blip in the early 90s, and then of course we saw the crash of 2007, which lasted until 2011. Outside of that, real estate appreciates in value. I cannot say that enough. So if you're waiting for home prices to come down because like, oh, they've gone up too much, let's look at this right here, 1977 through 1979. They went up by, shoot, let's go back to 1974, 10, 17, 25, 40, 56, 70% from 1974 to 1979. What did they do for the next decade? They continued to rise. And then we saw a small decline followed by another significant rise over a 10, 15-year period. Now, past performance is not indicative of future returns. However, I think a 80-year span is pretty good data to take a look at. Anyways, that is all I have for you today. If you are watching on the Powerhouse YouTube channel, thank you so much. Make sure that you hit that subscribe button down at the bottom. This side, hit that subscribe button so that way you've got the latest, greatest market, real estate, economic, mortgage news at the tips of your fingertips. If you're watching us in our Powerhouse Facebook private group, thank you so much for being an incredible part of our community. If you have any questions, don't hesitate to reach out. You can reach me at the number below. You can also comment below and I'll be able to respond to you as well. Until next week, have an incredible rest of your week. For SRT Live, I am Sean with the Sean Richard Mortgage team. Thanks so much for joining me today. Take care.